Introduction. Ever felt like you're doing everything right in trading but still losing money? You watch YouTube videos, follow signals, try new indicators, but your account still goes down more than it goes up. Yeah, I've been there too. Most traders start with high hopes. They dream of freedom, financial control, working from anywhere. But after a few bad trades, stress kicks in, confidence drops, and slowly the dream starts to feel impossible. Here's the truth nobody tells you. Trading isn't just about strategy. It's about rules. It's about discipline, mindset, and learning how not to destroy your own progress. That's why I wrote this book, 25. Rules of Trading isn't just about charts or setups. It's about how to think, act, and win like a real trader. You'll learn how to protect your capital like a pro, how to control your emotions during trades, how to avoid rookie mistakes that cost thousands, and how to build a system that actually works for you. If you've ever felt stuck, confused, or frustrated with trading, this book is for you. And it's not just about money, it's about building the mental strength and decision-making power that can change your life far beyond the market. Before you start, make sure to subscribe our channel to become 1% better every day. Chapter 1. Mindset Before Money. Have you ever wondered why some traders with less knowledge and experience still make consistent profits, while others, who know every indicator under the sun, blow up their accounts again and again? It's not about strategy. It's not about tools. It's about mindset. Before money ever enters the picture, your mind is already trading. Every decision, every hesitation, every emotional reaction is the result of your internal programming. That's why this chapter comes first. Because the difference between a gambler and a successful trader, it's all upstairs. Let's be honest. Most people come into trading thinking it's a quick way to make money. They imagine hitting big profits overnight, working from a laptop on the beach, and escaping their 9 to 5. That fantasy is dangerous. It's the same mindset that causes people to chase trades, ignore risk, over-leverage, and break their own rules, all while telling themselves, "I'll be careful next time." But there is no next time if you keep blowing your account. So, what's the mindset of a real trader? It starts with acceptance. A trader accepts that losses are part of the game, that emotions must be controlled, that the goal isn't to win every trade. It's to survive long enough to win consistently. You're not in this to win a war in one day. You're in this to win over the next 1,000 days. The truth is, your biggest enemy in trading is not the market. It's you. Think about the last time you broke your trading plan. Maybe you saw a green candle shoot up and jumped in, fearing you'd miss the move. Maybe you moved your stop loss further down, thinking, it'll come back up. That voice in your head, convincing you to do what you shouldn't, that's your emotional brain taking over. And it costs money every time. Successful traders are not emotionless robots, but they have mastered how to respond to emotion. They pause when they feel anxious. They walk away when they feel greedy. They wait when everything inside screams, "Just click buy." That level of control is not luck. It's built through discipline. And discipline isn't a skill you magically get after a few months. It's a habit. It starts the moment you wake up. That's why most top traders have routines. They understand that mental clarity matters more than any tool or indicator. If your mind is chaotic, your trades will be too. Start noticing how your day begins. Are you rolling out of bed and checking charts in a rush, already stressed? Or do you take time to clear your head, journal, breathe, and review your plan? What you do in the first 30 minutes of your day sets the tone for how you handle risk, fear, and uncertainty. And let's talk about fear, because it's everywhere in trading: fear of missing out, fear of losing, fear of being wrong. Most traders operate out of fear without even realizing it. They jump into trades not because it's part of their system, but because they're afraid of missing a move. That's not strategy. That's survival mode. And survival mode makes you impulsive. Greed is just as toxic. The moment you start thinking, let me double this account today, you've already lost. Greed clouds logic. It makes you ignore your stop loss. It tells you to over-leverage, and then it laughs at you when the trade turns against you. The truth? Trading is not about getting rich fast. It's about not going broke. You must shift your mindset from how much can I make today to how well can I execute my plan. Today? That one shift will separate you from 90% of traders. Here's another truth. Most traders lose because they never define who they are as a trader. They try to be everything. They day trade, swing trade, scalp, trade crypto, Forex, stocks, all at once. That's like trying to be a sprinter, marathon runner, and swimmer at the same time. It's chaos. And chaos kills consistency. If you want to win, you need an identity. Ask yourself, am I a patient swing trader who waits for high probability setups? Or am I a disciplined scalper who plays small, precise moves? Define it. Own it. Live it. Because when your identity is clear, your actions follow. And consistent actions lead to consistent results. Think about professional athletes. They train for their exact sport. They don't wake up and say, today I'll try tennis, maybe boxing tomorrow. They have routines, disciplines, and coaches. Yet in trading, where real money is at risk, people think they can wing it. You are now stepping into one of the most competitive games in the world. It's not just you versus the market. It's you versus your past habits. Every time you follow your rules, you upgrade your mindset. Every time you break them, you reinforce failure. Now you might ask, what do I do when I feel emotional? That's a great question. The best traders don't fight emotions. They manage them. They build habits that prevent emotions from taking over. That could be as simple as walking away after a losing trade, meditating before the session, or setting screen time limits. Yes, even breaks are part of trading discipline. One of the most underrated tools in trading is self-awareness. Start tracking how you feel before and after each trade. Keep a journal. Write down what triggered your decision. Was it confidence or fear? Logic or impulse? Over time, patterns will appear, and once you see the patterns, you can break them. Another crucial element is detachment. You are not your trades. If you win, it doesn't make you a genius. If you lose, it doesn't make you a failure. This is just data. Results, over time, will reflect your process, not your emotions. Professional traders think in probabilities, not predictions. They don't need to be right every time. They need to be consistent over time. They trust the process, even when individual trades go wrong. That's what separates winners from those who blow up accounts after one bad week. Let's also touch on belief. If you don't believe you can succeed in trading, your subconscious will sabotage you. You'll second-guess every setup. You'll hesitate when it's time to enter. You'll close trades too early. Your actions will match your belief. That's why affirming your identity is key. Tell yourself, I am a disciplined trader. I follow my rules. I protect my capital. I trade with patience and clarity. Repeat that every morning. Say it out loud, write it down. It's not woo-woo. It's neuroscience. Your brain rewires through repetition. Trading success isn't about one big trade. It's about small wins, done repeatedly, with control and clarity. It's about showing up every day, even when the market is slow. It's about staying in the game long enough to let your edge work. So if you're still thinking the next strategy or indicator will fix your trading, it won't. The real strategy is your mindset. Master that, and you'll start seeing results that feel almost unfair to others. Remember this: the market will always test your patience, discipline, and emotional strength. Every trader gets tested, but only those who master their mind will pass the test. This book will teach you the 25 rules you need to survive, grow, and win in this world. But it all starts here, with your mindset. Before you can master charts, before you can build wealth, you have to master yourself. Chapter 2. Chart the Truth. Technical tools are useless without clarity. Let's get real for a second. Most new traders think trading is all about predicting the future. They obsess over finding the perfect indicator or the holy grail strategy. They believe that if they can just find that one secret pattern, they'll never lose again. But here's the hard truth. Most traders don't need more tools. They need more clarity. Clarity on what matters. Clarity on how to read a chart. Clarity on how to ignore the noise and focus on the truth. Because charts don't lie, but how you interpret them can. Understanding what a chart really is. A chart isn't just some colorful graph with candlesticks and lines. A chart is a visual story of price. It shows you the fight between buyers and sellers. It reflects fear, greed, hesitation, confidence, panic, and patience, all in real time. If you learn how to read that story clearly, you unlock an edge. But if you get lost in the noise, every dip feels dangerous, and every spike feels like a missed opportunity. That's when people chase, panic, and lose. So the first rule of chart reading is this: stop trying to predict. Start trying to understand. Trend versus noise. The million-dollar skill. Have you ever opened a 1-minute chart and felt overwhelmed? Price moves up, down, sideways, all within seconds. It feels chaotic. That's because you're staring at noise, not trend. Noise is the short-term price movement that doesn't matter. It's random. It's unpredictable. It's driven by scalpers, bots, and fear. But trend is the dominant direction of price over time. If you follow the trend, you're moving with the market. If you fight the trend, you're basically trying to swim upstream in a flood. Smart traders ask, what's the bigger picture saying? They don't rush into trades because a candle turned red or green. They zoom out. They wait for confirmation. They let the market show its direction. Then they follow. That's clarity. Candlesticks, your price. Language. Candlesticks are often overcomplicated by educators who want to sound smart. In truth, candlesticks are just a visual way of showing 4 things: the opening price, the closing price, the highest price, and the lowest price within a specific time frame. That's it. But here's the magic. Even though it's simple, when you stack candles together, patterns start to emerge. A strong green candle after a downtrend might show reversal pressure. A long wick on top might show rejection. A doji might mean indecision. You don't need to memorize 50 candlestick names. You need to observe the story they're telling. Look at where candles form. Look at how big they are. Look at whether buyers or sellers had more control. The chart is speaking. Your job is to listen. Support and resistance, the market's memory. Support and resistance levels are where price tends to react. Think of them as psychological walls in the market. Support is where buyers usually step in and say, "This price is too low. Let's buy." Resistance is where sellers say, "This price is too high. Let's sell." But here's where beginners mess it up. They draw too many levels. Every swing high, Every low becomes a line. The chart turns into a spider web. Stop doing that. Support and resistance should be respected, not cluttered. Only mark the levels where you see multiple reactions. That's where real money decisions happen. And remember, support can turn into resistance, and vice versa. If price breaks a support level and goes below it, that same level often becomes resistance when price tries to move back up. It's like a floor that becomes a ceiling. Watch these areas. They matter more than any fancy indicator. Indicators. Less is more. If you're using more than 2 to 3 indicators, you're not gaining clarity. You're drowning in confusion. MACD, RSI, moving averages, Bollinger Bands. Sure, they have their place, but they're all lagging tools. They show what already happened. The most successful traders use indicators to confirm, not decide. For example, an RSI below 30 might suggest a market is oversold. But that doesn't mean it will reverse immediately. It might stay oversold for a while. Moving averages. They're helpful for spotting overall direction. But if you trade just because price crosses a line, you're flipping coins. Here's what works better. Price action first, indicators second. Watch what price is doing at key levels. See how candles react. Then use an indicator as backup, not your main reason to enter a trade. The clarity mindset. Most people fail because they want certainty from charts. But trading isn't about certainty, it's about probability. When you read a chart, you're not predicting the future. You're stacking the odds in your favor. You're saying, based on this trend, this candle, this level, it's more likely that price will do X. That mindset shift changes everything. It removes pressure. It helps you accept losses as part of the game. It makes you patient and selective, which are two of the most profitable traits a trader can have. Real case study, from confusion to confidence. Let me share a simple but powerful example. A trader I worked with, let's call him Amir, used to chase trades all day. He'd flip between 1-minute and 5-minute charts, rely on 6 indicators, and jump in whenever he felt it's going to move. He lost $3,000 in 2 weeks. When we reviewed his charts, I asked one question. What story is the chart telling you here? He had no answer because he wasn't reading the chart. He was reacting to it. So, we stripped everything back. He started using only one time frame, 1 hour. He marked just 2 to 3 key support and resistance levels. He studied candlesticks near those levels. He only used RSI as a confirmation, not a trigger. Within a month, Amir cut his losses by 80%. He went from 10 random trades a day to 2 to 3, planned ones a week. He didn't make $10,000 overnight, but he stopped bleeding. And more importantly, he started trading with confidence and clarity. What you must remember, reading charts isn't about speed. It's about observation. It's not about buy here, sell there. It's about understanding what the market is trying to communicate. You're not smarter than the market. You're not here to outguess it. You're here to interpret, stay patient, and act only when the setup is clear. That's what separates consistent traders from gamblers. And here's the best part. Once you train your eyes to see with clarity, you'll never unsee it. Every chart you open will feel less like a puzzle and more like a familiar pattern. Every trade will feel less emotional and more intentional. This is the edge you've been looking for, and it doesn't come from buying another course or downloading another indicator. It comes from seeing the truth in the chart and trusting your read. Final words for this chapter, so next time you open a chart, pause. Ask yourself, where's the trend? Where are the key levels? What are the candles telling me? Is there clarity? Or am I forcing something? If you can't answer confidently, don't trade, because trading without clarity is gambling in disguise. This chapter gave you more than just chart tips. It gave you a mindset. And once you apply it, you'll see fewer fake signals, avoid unnecessary losses, and enter trades that actually make sense not just to your emotions, but to your logic. Now, you're not just looking at charts, you're reading the market like a pro. And that changes everything. Chapter 3. The Rulebook. Have you ever felt like trading is just too unpredictable? One day you're up, the next you're down, and it feels like you're chasing shadows. That's not trading. That's gambling. And the difference between a gambler and a professional trader boils down to one thing: rules. Rules are not optional in trading. They are your protection, your structure, your edge. Without them, you're relying on luck. With them, you're stacking the odds in your favor. Let's be real. Most people lose money in trading, not because they didn't have a strategy, but because they didn't follow a set of rules that keep them safe when emotions take over. This chapter is your foundation. If you take this seriously, you'll trade longer, lose less, and grow faster. If you skip it, well, don't say you weren't warned. Rule number 1, protect your capital, like your life depends on it, because it does. The number 1 goal in trading is not to make money. It's to protect money. Making money comes after you've learned how not to lose it all. You can always make more trades. You cannot make more capital if you keep blowing it. Once your account is gone, the game is over, emotionally, mentally, and financially. That's why every smart trader's first priority is risk management. This means never risking more than you can afford to lose. If losing a single trade makes you emotional, anxious, or desperate to get it back, then you're risking too much. Real traders trade with money they can lose without losing their mind. Rule number 2. Never risk more than 1% of your account on a single trade. Let's make this simple. If you have a $1,000 trading account, your maximum risk per trade should be $10. Yes, just $10. It may sound small, and you might think, but how can I grow fast like this? Here's how. By staying in the game long enough to learn, improve, and grow with consistency. Blowing your account fast may feel exciting, but it will teach you nothing. Trading small, consistent, and with patience will teach you everything. This 1% rule is your insurance policy. It allows you to take multiple losses without major damage. And trust me, losses will come. But with this rule, no single loss can take you out of the game. Rule number 3. Trade setups, not emotions. You're scrolling through your chart. A big green candle appears. Your heart races. Should I jump in now? If that question enters your mind, you're not trading. You're reacting. Chasing price is one of the biggest rookie mistakes. The market often gives you FOMO, fear of missing out, right before it reverses and takes your money. That's why your job is to wait. Wait for your setup. Wait for your edge. Wait for confirmation. Every good trader has a setup, a specific pattern, condition, or structure that tells them, this is my moment. They don't just press buy because the price looks exciting. They wait like a sniper. And when their setup appears, they strike with confidence and discipline. Rule number 4. Always use a stop loss. Always. This is non-negotiable. A stop loss is your exit plan before emotions enter the game. It tells the market, this is how much I'm willing to lose, not a cent more. Without it, you're exposed. One wrong move, one news spike, one emotional moment, and your account could be gone. Some traders say, I'll just watch the chart and exit manually. But when you're in a losing trade, your brain doesn't think clearly. You hope, you pray, you wait. And by the time you exit, the damage is already done. Set a stop loss before you enter a trade, every single time. And once it's there, don't touch it. Rule number 5. Have a clear entry and exit plan. Imagine getting into a taxi without knowing where you're going. That's how most traders operate, entering trades with no plan. And then they wonder why they end up lost. Before you take any trade, you must know 3 things: where you'll enter, where you'll exit if you're wrong, and where you'll exit if you're right. This gives your trade structure and clarity. It also removes panic. When you have an exit plan, you're no longer guessing. You're following a system, and systems are what make traders profitable over time. Rule number 6. Avoid revenge. Trading like a plague. You just lost a trade. You're frustrated. You want to make it back. So you enter another trade, fast, then another, and another. Before you know it, you've lost triple the amount, and now you're mentally wrecked. This is revenge trading. It's trading fueled by ego and emotion, and it's one of the fastest ways to blow an account. Losses happen, but your response to loss determines your long-term success. A pro takes a loss, reviews it, and waits for the next high-probability setup. An amateur tries to fight the market and always loses. The best traders in the world lose all the time, but they lose small and they never lose control. Rule number 7. Treat every trade like a business decision. Would a CEO invest in a company without doing research? Of course not. Then why should you? Every trade should be approached like a business move. You're investing time, energy, and capital. That means every trade must have logic, planning, and risk assessment. Emotions have no place in business. Neither do guesses. So take each trade like you're managing $1 million portfolio, even if your account is just $100. That mindset will build habits that scale. Rule number 8. Losing is part of winning. Here's something that will shock most beginners. You can lose 40% of your trades and still be wildly profitable. If your risk-reward ratio is solid, the goal isn't to win every trade. The goal is to make more on your winners than you lose on your losers. That's how real traders make money. Not by being right all the time, but by being smart when they're right and disciplined when they're wrong. You need to accept losses as part of the game. Don't fear them. Don't fight them. Learn from them. Respect them. And most importantly, don't let them define you. Rule number 9. Know when to stop for the day. Every trader needs a stop time. A moment when they close the laptop and walk away. Why? Because trading too much leads to fatigue, bad decisions, and overtrading. If you've hit your daily profit goal, stop. If you've hit your daily max loss limit, stop. Trading is a marathon, not a sprint. There's always another opportunity, tomorrow. But mental energy? Once it's drained, it doesn't reset with another trade. Protect your mental capital as fiercely as your financial capital. Sometimes, the smartest trade is no trade at all. Rule number 10. Journal. Every trade. This sounds boring, I know, but this is where real growth happens. When you write down your trades, your entries, exits, reasons, and emotions, you begin to spot patterns. You discover what works, what doesn't, and how your mindset affects your performance. Your journal becomes your personal mentor. It shows you the truth, not the story you told yourself, but the actual data of your decisions. Want to become a better trader every week? Journal. No excuses. Chapter 4. Master the risk game. The fastest way to lose money? Not respecting risk. Imagine this. You're in a winning trade. Charts look good. You're up 15%. You feel confident. No, you feel invincible. You skip your stop loss because it'll bounce back. But a few hours later, the market turns against you. Panic sets in. You freeze. And just like that, the entire profit and more is gone. This is how most traders lose. Not because they didn't know what to do, but because they never learned how to manage risk like a business. Risk management isn't the sexy part of trading. It's not what gets the likes on Instagram or the flashy screenshots, but it's the difference between a trader who lasts 3 months and one who builds real wealth over years. Let's be honest. Most people enter trading hoping to get rich quick. But the ones who actually succeed, they don't treat it like a lottery ticket. They treat it like a business where risk is the number one expense, and their job is to control it ruthlessly. You're not a gambler, you're a risk manager. Here's something every pro trader knows. You don't get paid for winning trades. You get paid for managing risk well over a series of trades. You will lose trades. That's guaranteed. The question is, how much will you lose when you're wrong? If you can control your losses, if you can protect your capital, you give yourself time and space to stay in the game long enough to win. Every professional trader, hedge fund manager, or algorithmic trading system focuses on one key principle: preserve capital first, grow it second. That mindset shift alone can change everything for you. The power of the stop loss. Let's talk about one of the simplest but most ignored tools in trading: the stop loss. A stop loss is not just a line on a chart, it's a promise to yourself. A promise that you won't let emotion destroy your logic. It's your insurance policy in the market. The moment you enter a trade without a stop loss, you're telling the market, take as much of my money as you want. That's not trading. Noix, that's gambling. Yes, stop losses can get hit early. Yes, sometimes the price bounces right back after hitting it. But here's what matters more: consistency. Over time, using stop losses saves you far more than you lose by getting stopped out occasionally. It keeps your losses small, manageable, and predictable, which is exactly what you want as a trader. The most dangerous trader is not the one who takes a loss. It's the one who can't accept it. The one who refuses to close a losing trade until it's too late. The market doesn't care about your ego, your opinions, or your hope. It rewards logic. It punishes emotion. Risk-reward ratio. You're silent. Profit maker. Here's another rule that most beginners ignore until it's too late. Never take a trade unless the potential reward is at least twice the risk. This is called the 2-1 risk-reward ratio, and it's a trader's best friend. Let's say you risk $100 per trade. If your setup offers a chance to make $200, great. That's 2-1. Now imagine this. Even if you're wrong, 60% of the time, you'll still be profitable. Why? Because your winners are bigger than your losers. This single concept, if applied with discipline, can turn an average trader into a consistently profitable one. It takes the pressure off being right every time. Instead of focusing on being perfect, you focus on managing risk and letting the math work in your favor. This is how the pros play the game. They don't try to win every trade. They try to win the war over time. Blowing up, a real story. Let me share a real example. I once coached a young trader named Amir. He was smart, fast, and passionate, but he hated losing. Every time a trade went against him, he'd give it more room instead of cutting it. He doubled down, Sometimes it worked, until one day it didn't. One trade went deep into the red. He kept holding. He was sure it would reverse. It didn't. He lost 70% of his account in one trade. Months of progress, gone in a few hours. The sad part? He knew better. But his ego got in the way. He didn't master risk. He tried to master the market, and the market taught him a brutal lesson. I've seen this story play out hundreds of times. It's always the same. Traders who don't respect risk end up watching their capital vanish, slowly or suddenly. And when capital is gone, the opportunity to trade is gone too. Trade like a business, not a hobby. Think about this. Would any business survive if it spent 80% of its income randomly without a budget or system? No, it would collapse in a month. Yet that's how most people trade. No system, no rules, no risk management. The best traders I know have a clear plan. They know exactly how much they'll risk on each trade, usually 1 to 2% of their total account. They use stop losses religiously. They focus on preserving cash. Because in trading, cash is your oxygen. If you blow your account, it doesn't just hurt financially. It damages your confidence, your mindset, and your trust in yourself. And recovering from that is 10 times harder than taking a small, controlled loss. The hidden cost of overtrading. Let's talk about another silent killer. Overtrading. Even if you have good setups and decent risk management, taking too many trades can drain your account. The more you trade, the more you're exposed to the market's randomness. Not every move is an opportunity. Not every candle needs a reaction. Most of the time, the best trade is no trade. Trading should be boring. It should feel like a factory. Repetitive, systematic, emotionless. If you're always feeling adrenaline, excitement, or panic, you're not trading, you're chasing. And in chasing, you burn money. Capital preservation, the #1 goal. Let's be crystal clear. Your #1 job as a trader is not to make money. It's to not lose it. That may sound strange, but it's the only mindset that builds long-term success. When you focus on protecting capital, you avoid desperate moves. You wait for high-probability setups. You trade less, but trade smarter. You give yourself the freedom to survive bad days and thrive on good ones. Trading is a marathon, not a sprint. Those who win are not the fastest. They're the most disciplined. They manage their risk like their life depends on it. Because in trading, it kinda does. The math of survival. Here's some brutal math. If you lose 50% of your account, you need 100% gain just to break even. If you lose 80%, you need a 400% gain to recover. That's why small losses are manageable. But big ones are devastating. This is why pros obsess over risk. Not because they're scared, but because they respect the math. Start thinking like a pro if you're still treating trading like a game of chance. This is your wake-up call. Trading is war. Every trade is a battle, and your only weapon is risk control. Want to survive this war? Want to grow your capital and your confidence? Then start thinking like a risk manager, not a gambler. Before every trade, ask yourself, what's the worst case scenario? Am I okay losing this amount? Does this setup meet my risk-reward criteria? Where is my stop loss, and why? If you don't have clear answers to these questions, don't take the trade. Chapter 5. Strategy over Signals. Why you don't need 10 indicators, just one working edge. If you're like most traders starting out, you've probably downloaded every free strategy PDF you could find, subscribed to a dozen YouTube channels, and cluttered your charts with enough indicators to make your screen look like a cockpit. You've used RSI, MACD, Fibonacci, moving averages, volume profiles, Bollinger Bands, and probably tried trading astrology at some point when nothing else seemed to work. And still, you're stuck. Here's the painful truth most people ignore. You don't need more signals. You need a strategy, one that's simple, repeatable, and tailored to how you trade best. In fact, the more indicators you have, the more confused your brain becomes. Every indicator tells a different story. One says buy, the other screams sell, and you end up doing nothing. Or worse, making impulsive trades just to feel productive. This is how traders burn out. They chase confirmation instead of clarity. The most successful traders in the world often rely on just one or two setups. That's it. They've mastered a system that works for them, and they stick to it with monk-like discipline. They don't need to be right all the time. They just need to be consistent, and their system gives them that edge. So what exactly is a trading system? Think of a trading system as your personal blueprint, a step-by-step process that tells you when to trade, why to trade, and how much to risk. It's not something you copy-paste from someone else. It's built through experience, observation, and adjustment. And once it works, you don't change it every week. You refine it. A good trading system has just a few key ingredients. First, you need a clear setup, a specific market condition or chart pattern you understand deeply. This might be a trend-following setup, a breakout, a pullback, or a reversal. Whatever it is, you must be able to recognize it instantly on a chart without hesitation. If your eyes have to search for it, it's not your setup. Next, your system should define your entry point. This is where discipline kicks in. Many traders get the setup right, but enter too early or too late, sabotaging their edge. A solid entry rule keeps you from guessing or feeling your way into a trade. Emotions are expensive. Logic is profitable. Then comes your exit strategy, both for taking profits and cutting losses. One of the biggest mistakes traders make is having no clear plan for when to get out. They hold on to losing trades, hoping they'll bounce back. They cut winning trades too soon, fearing the profit will disappear. A proper system eliminates this guesswork by giving you a fixed reward-to-risk ratio, or specific exit rules, like trailing stops or fixed targets. But even the best strategy means nothing if it hasn't been back-tested. Backtesting means checking how your system would have performed over historical data. It's not perfect, but it gives you confidence. When you test your setup over 100 trades and see a win rate of 55% with a 1.2 risk-reward ratio, you begin to trust the math. And that trust stops you from panicking during drawdowns. That trust builds emotional resilience, which is a trader's secret weapon. Now here's where most traders mess up. They don't give the system enough time. They take 4 or 5 trades, lose a couple, and then scrap the system entirely, looking for the next holy grail. This cycle of system hopping is deadly. The market doesn't owe you instant results. It rewards those who master one thing and keep showing up. This brings us to trading plans. A trading plan isn't just a document. It's your discipline on paper. It answers all the important questions. What time do you trade? What setups do you take? What is your max loss per day or week? When do you walk away? Most importantly, it forces you to think ahead, because every impulsive decision you make during a trade costs you money. A plan protects you from your worst impulses. Having a plan also keeps you out of trades you shouldn't be in. One of the most dangerous habits for a trader is overtrading, getting into positions just to feel busy. Overtrading is emotional. It comes from boredom, revenge trading, or the illusion of opportunity when the setup isn't really there. Your strategy should filter this noise. It should say, if A plus B plus C don't line up, don't trade. That level of self-control is rare and profitable. Let's talk about something very few people teach: journaling. Most traders hate this part. It feels boring, like homework, but this is where you grow. Journaling forces you to be honest. Every trade you take should be logged. What was your setup? Why did you enter? Where was your stop? What happened? How did you feel? Over time, this journal becomes your private goldmine of data. You'll see patterns in your mistakes. You'll notice you perform worse on Mondays, or that your best trades happen after 10:30 a.m. You'll realize you're too aggressive after a losing trade, or that you're ignoring your stop loss when you feel the market will reverse. These insights can shave months, even years, off your learning curve. Let me say this clearly. If you're not journaling, you're gambling. You're reacting instead of refining. You can't improve what you don't measure. A simple spreadsheet or notebook can double your learning speed. It's not sexy, but it's powerful. Now, here's something personal. When I finally stopped chasing signals and built my own strategy, everything changed. I wasn't trying to predict the market anymore. I was simply responding to it based on a system I trusted. That shift gave me confidence. I started thinking like a business owner, not a gambler. I didn't need to trade every day, I just needed to trade my setup when the market gave it to me. And that's when I started winning consistently. Trading isn't about being right all the time. It's about having a small edge and using it over and over with discipline. The problem is, most people never find their edge because they're too busy trying to copy everyone else. They think more signals, more success. But it's the opposite. The fewer variables you trade, the clearer your mind becomes. This chapter isn't just a lesson, it's your turning point. If you truly want to stop bleeding money and start growing as a trader, stop asking, what's the best strategy? And start asking, what setup can I master and execute better than 95% of people? That's how you build an edge. That's how you build confidence. And that's how you win. So slow down. Strip your chart. Kill the noise. Pick one setup. Backtest it. Build a plan. Journal your trades. Stay disciplined. This is the boring work that makes you rich. No signal service will give you that, but your own system will. And when you truly commit to mastering it, that's when you stop trading emotionally and start trading professionally. That's the real edge. Chapter 6. Scale like a shark. Trading is a journey, not a sprint. When you first start, the focus is often just on making your first few profitable trades. But if you want to truly succeed, to turn trading from a hobby or side hustle into a full-time, consistent income, you need to learn how to scale your trading properly. Scaling is about growing your trading size and capital methodically, safely, and strategically. It's about multiplying your profits without multiplying your risks. And like a shark in the ocean, you must be patient, aware, and ready to strike at the right time. Scaling is one of the biggest challenges traders face. Many hit a plateau in their profits and feel stuck trading small sizes or low risk because the fear of losing bigger money holds them back. Others get overconfident and try to scale too fast, which often leads to devastating losses. The truth is, scaling is both a skill and a mindset, and it requires discipline and planning, just like every other part of trading. Before you even think about increasing your trade size or your capital, you must have a solid foundation. This means having a proven trading system or strategy that works consistently over time. If you don't have a reliable edge, something that gives you an advantage in the market, scaling up will only amplify your mistakes. Imagine trying to build a skyscraper on weak ground. No matter how tall you build, it will collapse. The same applies to trading. Scaling amplifies both your gains and your mistakes, so your foundation must be rock solid. Once you're confident in your strategy's consistency, the next step is to master the art of compounding. Compounding is a simple yet powerful concept. Instead of withdrawing your profits right away, You reinvest them to grow your capital exponentially. This is how the wealthy grow their wealth faster than those who just save or invest small amounts. But compounding and trading requires patience and restraint. It's tempting to take profits out quickly, especially when you feel the market is uncertain or when you need cash for other expenses. But the traders who learn to keep their profits working inside their accounts and scale gradually are the ones who become truly successful over time. Scaling is not just about putting more money into trades. It's about increasing your position, size proportionally to your account growth while maintaining strict risk management. For example, if you risk 1% of your trading capital per trade, when your account grows, your trade size should grow as well. But the risk per trade remains constant. This keeps you protected from large drawdowns while steadily increasing your profit potential. Many traders fail to do this. They increase their trade size but also increase their risk, which leads to bigger losses and can wipe out months or years of gains. To keep scaling successfully, you need to develop a review system that helps you learn from your trades and adjust your strategy over time. This includes daily, weekly, and monthly reviews of your trading performance. Daily reviews allow you to reflect on the trades you made each day, what worked and what didn't, and how you managed your emotions. Weekly reviews give you a bigger picture view, identifying patterns, strengths, and weaknesses in your trading. Monthly reviews are crucial for assessing overall progress, evaluating your risk exposure, and deciding if you're ready to scale up further. Without regular reviews, it's easy to fall into bad habits or repeat mistakes that could cost you dearly. Trading larger amounts of money also changes your psychology. It's normal for fear, anxiety, and self-doubt to creep in when you trade with bigger capital. The stakes feel higher, and every decision carries more weight. This can lead to hesitation, overthinking, or impulsive decisions, all of which harm your trading performance. The best traders learn to separate their emotions from their decisions. They build confidence by trusting their systems and by accepting that losses are part of the game. This mental toughness is essential when scaling because the pressure increases, but your mindset must stay calm and objective. Another important aspect of scaling is knowing when to stop increasing your trading size and consolidate your gains. Growth in trading's not always linear. There will be periods of drawdowns or sideways performance where pushing harder only leads to frustration and losses. A wise trader knows when to pause scaling, focus on refining their strategy, and protect their capital. Sometimes, stepping back is the best move to prepare for the next phase of growth. Building a long-term trader's lifestyle means thinking beyond just profits and losses. It means developing habits that support your physical, mental, and emotional health. Trading can be stressful, especially as you scale, so taking care of yourself is non-negotiable. This includes getting enough sleep, exercising, eating well, and having downtime away from screens. It also means managing your finances wisely, keeping some profits aside, paying taxes, and avoiding lifestyle inflation that outpaces your trading growth. True success in trading comes from viewing it as a business, not a gamble or a hobby. When you approach trading with a business mindset, scaling becomes part of your growth strategy, not a risky bet. You set goals, track key metrics, reinvest profits smartly, and continuously improve your edge. This discipline separates the sharks from the minnows. Remember, sharks don't rush. They are patient hunters who wait for the right moment to strike. They understand their environment, respect their limits, and use their power strategically. You can do the same in trading by scaling methodically, respecting risk, and building a system that works for you in the long run. By the time you finish this chapter, you should understand that scaling isn't about chasing big wins quickly. It's about building your trading capital gradually, managing your risk with laser focus, and developing the emotional strength to handle larger stakes without losing control. This combination will help you transform from a hobbyist into a confident, full-time trader who consistently grows wealth and thrives in the markets. The journey to scaling your trading profits may feel long and challenging, but it is one of the most rewarding paths you can take. It tests your discipline, sharpens your skills, and ultimately changes how you think about money and risk. As you scale, you'll not only see your account grow, you'll see yourself grow as a trader and as a person. And that is the real victory.